Hello, everyone. My name's Andreas Vecchiet, and I'm your host on today's episode of the Moneyverse Show. This show is all about helping you and fellow individuals navigate the world of money and be on top of your personal finances, such as income, bills, debts, savings, mortgages, investments, taxes, and family commitments. It's about answering your personal finance questions with the help of experts who are experienced in money and have practical suggestions. Our show is purely for education. We are not a financial services organisation, and you will never be sold any financial products or receive information that comes from any financial institution. Comments shared and exchanged in the show are for your personal educational benefit only. In today's show, our resident finance and wealth expert Lionel Lee will discuss some burning personal finance question with today's guest, Thomas Birmingham Glover. By way of background, Lionel Lee is a writer and commentator of more than 2,000 articles for print and digital media as a multinational business and finance expert. He has taught finance, investment, business and entrepreneurship for over 10 years in the US, Singapore and Australia. He is a personal finance expert with the Better Foundation, a private foundation delivering personal finance education to over 10 million people worldwide through its Moneyverse content and programs. And now I'll introduce our guest. Thomas is from Ballarat, Victoria, Australia, and works in tertiary education. He says his main goal is to pay off his mortgage as quickly as possible. Thomas, welcome to the Moneyverse Show.
Thank you for having me.
You're welcome. Over to you, Lionel.
Thomas, thanks for joining us on the Moneyverse Show. How's the weather in Ballarat?
It's sunny at the moment, but yesterday it was very stormy and very humid. So we're flipping between sort of Queensland weather and classic Victorian weather, and I don't know how to dress for it.
Yeah, so I'm calling you from Seoul, and it's actually going into early winter right now, so temperatures are gonna drop to about 1-2 degrees today. Yeah, so nice and cold here compared to back in Ballarat. So, but I'm definitely looking forward to visit Victoria and hopefully Ballarat next year. You have a question for us, and let's hear it, and then we'll try to work through the solution together.
Yeah, I sure do. So my question is, once I've got a good emergency fund saved up, should I sort of keep paying money into that fund to sort of expand it, or should I be taking that money and putting it into my mortgage to get that paid down?
Oh, that's a great question. I think it's good that you're actually thinking about ways to pay down the mortgage, especially in an environment of high interest. And a lot of Australians should be thinking along the same lines. I think before we actually talk about the mortgage side, I just wanted to understand from you what a good emergency fund looks like.
Yeah, so my emergency fund was sort of set up in COVID, and at the time I sort of set it up based on 8 sort of weeks of a mortgage repayment in that property I was in at the time. So that looked about sort of a $2,000 sort of emergency fund, which would also cover, other things that might go wrong that may not be necessarily mortgage related, but, home maintenance related. But now I've sort of moved into a larger property.
Okay.
The repayments of my mortgage and interest rates have gone up. So a emergency fund is probably closer to about $4,000 to still cover that 8-week period.
Okay. So it's great that you have got a formula of 8 weeks. Again, some folks might say that emergency fund might be too little. It just depends on the individual's requirements, as in your case, what you feel are emergencies to you and what you need to actually budget for. So it's just about bridging that gap between 2K to 4K at the moment, right?
Yeah.
Okay, so that's what you're currently doing to actually close the gap on the emergency fund. Can I also ask, with the emergency fund, is that just purely cash in a bank account right now?
So it's currently cash in a savings account.
Okay.
With I think they call it like a reward saver bonus.
Right.
So if it expands month on month, the interest rate's higher as opposed to if it retracted, where the interest rate would be pretty abysmal.
That's good. So it's in a high yield savings account of some sort that it's giving you more interest if you keep the money in that account. So that's really a good step. And probably another way, if you haven't actually used it, is to think about income protection insurance. So that will actually give you a buffer, that can be anywhere between 3 months to 6 months, to actually cover for any kind of emergencies that are that may happen, and if you're in a situation where your income is affected. So that might be another thing to think about in addition to your cash buffer that you have right now in a high yield savings account. With regards to the mortgage, apart from your high yield savings account, are you using like an offset account or maybe a withdrawal facility?
So not currently got an offset account, but I do have redraw on my mortgage, which I was offered one or the other and I chose to redraw.
Okay.
But it's not, I know sort of how it should work, but it's not working the way I had expected it to work with my current home loan provider. So an offset account is something I've also looked at as well.
Okay, so with the withdrawal facility, as you mentioned, it hasn't worked the way that your home loan provider has mentioned. So just to clarify how a withdrawal facility actually works, it's essentially just when you pay extra into your home loan, right, you are able to withdraw it when there's an emergency. So it's as simple as that. That's why it's called a withdrawal facility, right? So you put in extra money in there. It's counted as extra repayments. It reduces the interest that you have on the loan, but you are able to withdraw that fund later if you require. Yep. So that's essentially how a typical withdrawal facility works. And it's good that you actually opted for that from your home loan provider, because a lot of fellow Australians would organize a home loan but wouldn't be looking at any kind of facility that allows them to reduce the principal and or interest. So the offset account, I'm not sure if you're familiar how it works. Just to clarify, essentially you would put money into your offset account. This could be, again, your salary, for example, any other form of income that goes in there. It is linked to your home loan, so it reduces the loan principal on which the interest is calculated, but at the same time your money remains accessible.
All right. Okay.
Yep. So that's simply how an offset account works in general. It does, of course, differ slightly from loan provider to loan provider. So my own thinking is that coming up with a solution that is practical and that you can actually implement after the show is to have a chat with your loan provider, clarify how that withdrawal facility actually works and that you're using or applying that withdrawal facility correctly to your benefit, and also to find out if you can be able to get an offset account at the same time. So how I would do it is that I would consider, based on information from your lender, if you can actually build your emergency fund in that offset account. So right now your emergency fund, from a cash deposit perspective, sits in a high yield account, right? So it's great that it's got higher interest when you retain the monies there, and as you add more to it, they give you some additional interest here and there as well. But compared to your home loan, if your home loan interest is much higher than what you're getting in that high yield savings account, it might be worthwhile to actually create your emergency fund within an offset account, right? So you still have your emergency fund, but you actually now have a way to reduce the principal on your home loan. So you're getting best of both worlds without losing the safety net that you are trying to create through an emergency fund.
Yeah. Okay. Yeah, that makes sense.
Right? So I know that most Australians don't do that because it's not commonly practice, but that's how I would do it if I were you, because I think the challenge is that most Australians right now, with the high cost of living and the high interest rates, if you have a home, is trying to juggle both, right? So you're forced to, or maybe not you, but many people are forced to do either or. You're either just doing your savings, or you're just trying to actually pay down your mortgage. Are you finding yourself in that situation, Thomas?
Yes and no.
Okay.
I do dedicate, obviously, an amount to go to the emergency fund to ensure that there's that buffer. So as a result, I'm not paying as much down on my mortgage as I potentially could be if I wasn't funneling money into that safety buffer.
Yes. Yeah. So you're in a situation whereby you're having to do either or, right? So money's go into savings account or emergency fund. It doesn't actually then allow you to reduce your mortgage. So if we combine the emergency fund into an offset account, then you've got the ability to do both at the same time. Having said that, your offset account is not going to give you the high interest that your high interest or high yield savings account is giving you right now, right? So that's something that you have to be aware of, but just double check what the rates are between the high yield savings account and the offset account in relation to the interest that you're paying on your home loan, right?
Yeah.
So that would be the way that I would approach it. And then your withdrawal facility already exists, so therefore whatever extra that you have, this is nothing to do with your emergency fund now, right? So it's not your regular savings, so it's extra. Like, for example, maybe you got a bonus from work, or maybe that Oz Lotto ticket won you a couple of $100, and you throw it into that withdrawal facility, so that it's just the extra that you pay into the loan allows you to actually reduce the interest. So that's just on top of what the offset account is going to do. So the second way that we're going to help reduce your home loan is to combine the offset account with the withdrawal facility.
Yeah, okay.
Yep. But you have to check with your lender if they are willing to actually provide you with both facilities at the same time, because some lenders offer either or.
Yeah, okay, that
Right.
makes sense.
Yeah. So in the situation where your lender offers only either or, then my other suggestion is shop around for other lenders that are willing to actually do both for you. Look at the interest rates as well, and then consider maybe the switch if your current loan arrangements allow you to do that.
Okay. And
yeah,
if I'm allowed to ask a cheeky another question.
Yeah, please go ahead, Thomas.
If for whatever reason I can't move the mortgage, if it's in an exclusive period and I'm only offered a redraw or an offset, is there a benefit to only, like, I suppose, which one's probably better, bearing in mind that the idea is the emergency fund would be about $4,000. Is that better in an offset, or shall we put in that as a redraw?
Yeah. So the offset account, if you can get that facility, allows that the monies in the offset account to actually reduce the principal. So remember, interest is paid on principal. So it's not about reducing the loan. It's about reducing the principal that makes the loan, right? So if you have less principal, whatever interest that is actually charged on that principal will be lowered in terms of its absolute amount, right? So 5% interest or 6% interest on $500,000 versus the same 5 or 6% on 450 makes a difference in terms of absolute amount, right? So you want to lower your principal. You don't want to just pay off interest. So the combination of an offset and a redraw facility allows you to actually get best of both worlds. So that is what I would try to negotiate with my lender on. And if you, as I mentioned, if you can switch to a lender that allows you because the current lender doesn't, then consider that. or have that conversation with your lender and say, look, if I don't have that facility, I'll have to consider actually going to another lender. They might then say, look, Thomas, you're a great customer, we want to keep you, and let's try to find a way to actually help you with both facilities. So it might be just part and parcel of having that conversation, but it's a conversation that you can actually start with your lender after this call.
Yeah, okay.
Yeah, so that would be a way to actually make an immediate impact on the principal and the interest that you're paying. So are you on a P&I or principal and interest loan, or it's a variable loan right now?
It's variable, but it is principal and interest. So ideally, I'm paying down the principal and the interest, but
Yes.
with the interest rates as they are at the moment,
Yes,
it's mostly all interest.
that's right. Yeah, that's right. So it's
so
lowering that principal as much as possible.
Yeah, you've got the gears turning. A really, really, interesting
No problem,
phone call
Thomas.
after this one.
Yeah, no, it's good. It's all about helping you, to basically address the situation or the question that you have. So, we're again happy to have this conversation and find ways to actually make your issue with emergency fund and your mortgage repayments, work better for you. Yeah.
Yeah, no, I appreciate that.
Our pleasure. Thanks so much, Thomas.
Thank you.
Okay, thank you very much, Thomas and Lionel, for such an interesting conversation, especially when interest rates are so high and millions of Australians are facing the same issue of how to get my principal down while I have enough to cover my life expenses and possible emergencies. So thank you for that. To follow our videos, subscribe to our YouTube channel, I Want a Better Life. And if you would like to be a guest on the show, please visit the Contact Us page on our website, www.intothemoneyverse.com. That's intothemoneyverse, one word.com. Thank you very much, everyone, and see you next time.